the first thing that I would recommend as people encounter a market like this or encounter a more difficult market is to maintain a position of strength. But as you can see, even though the fundamentals under NVIDIA are technically improving, you have consolidation where usually you would have a breakout. And you can see something very similar in a name like VE, which I've had a swing on for a long time.
One thing I like to keep in the forefront is that we're paid in opportunity and not in hours worked. If you're comfortable in a certain situation, a certain scenario in the market, focus on the opportunities that you're best at, that you're most comfortable at, and not be sitting there smashing buttons all day long because you're churning and burning, you're not getting anywhere.
Hello, and welcome to Investors Underground. My name is Anthony, and today I'm joined by a couple of the Investors Underground members and moderators, Chris Lanzilotti and Dawson Hanzlick. And we're going to be discussing some of the current volatility that we've seen in the markets in early 2026, which has caught so many traders and investors off guard. And the purpose is to discuss some concepts and ways that hopefully you're able to introduce into your trading, not only just to survive 2026 and the volatility, but also to hopefully thrive in the volatility moving forward. So it's my pleasure to introduce Chris and Dawson. Hello, Chris. Hello, Dawson. Thanks for being here.
What's going on? Good morning.
Hi, Anthony, Dawson. Great to be with you guys. I'm excited to talk about this topic.
Yeah, absolutely. Absolutely. You know, I've been seeing online so many great traders and people that I know are profitable posting about how they're having difficulties in this market. And, you know, some people are looking inward, some people are blaming other sources. And, you know, I think it's a great topic because as the market changes, different cycles, different catalysts, these types of topics and different types of volatility happen in the markets, you know, every couple of years, or, you know, you hear about some down market cycles where people were less active. Some people just say they had big blowups during certain years. So I think this is really important to discuss for traders and longevity.
Absolutely, yeah. Especially as people have, long careers, because what I notice tends to happen is that a lot of times people have fairly niche strategies, and so a lot of times specific traders will kind of fall out of favor with the market, or maybe something's not clicking for them. But then you'll have these market regimes or these situations where that's happening to a lot of people at once. And so I think we're in one of those times where it's a little bit more difficult for a lot of different types of styles rather than just one or two. So I think there's some good ways to go about navigating that I've experienced, over my career.
Yeah, we've talked about this behind the scenes, Chris, where like we were mentioning a few months ago, where if you're not building out your Swiss Army knife or your playbook or whatever traders call it, same kind of idea. But if you're not building that out in those slow times, or even when things are working, and just dabbling in some other areas on the side for when those new market cycles come, when those hot strategies that are working in that environment stop working, and then you have something else to pivot to, which is how you maintain a career and not just like a flash in the pan sort of thing.
Yeah, absolutely. And I think it's really good to have you guys because you really represent a breadth of styles. You know, Chris, I know you trade options and look at some of the larger names and have a very macro picture and outlook, as well as taking a look at the smaller caps. And Dawson, I know you really excel at some of those, smaller, cheaper priced stocks that still have a potential to move in markets like this, 20%, 50% or more, depending on how things are playing out. So I'm really excited for this conversation. And I wanted to kick things off by just, asking from your perspective, Chris, maybe we could start with you. What are you seeing from a very macro perspective and the types of drivers in this particular market in early 2026?
Yeah, definitely. So like I refer to these periods as market regimes. And what that means to me is you basically have a combination of factors that makes for some kind of market conditions. So a way that I like to navigate market regimes is to start with objective realities. So it's a little bit different. A lot of people like to say, oh, we're in a bull market. Oh, we're in a bear market. Oh, we're in a chop market. But what happens is that if you categorize the whole market into one of those, categories, then everything that you see, you try to fit it into that bucket instead of starting with objective realities and working backwards that way. So what I like to do when I'm in a market regime is just observe what is actually happening and just take some notes of what I'm actually seeing and then piece together my market view that way. So objectively, what I've seen in 2026, and especially during this current market regime, I see a lot of the index kind of being a little bit more in a range. While under the surface of the index, you have a lot of big moves separated by AI winners and losers. And then you also have some other things like commodities have been very in play. You have the options market not as crowded on the option selling side. And so a lot of the moves are exacerbated. So you have like wider intraday ranges and a lot more reversals. You have a higher VIX environment. You have some macro catalysts on the horizon. You have things with the tariffs. You have things with the new Fed chair. You have things with currency moves. So there's a lot of things in play. And what tends to happen is that if you have markets that are going, if they're bifurcated, which means that you have one sector doing really well and then one sector doing really poorly, and they're in the same index, a lot of times you get that index stalling while you have maybe financials, doing okay and tech is doing kind of weak. And then when tech is doing okay, financials get kind of weak and the market just kind of stalls. So that's one of the things that I try to observe. I just make notes of what am I actually seeing versus what, broad picture can I paint the entire market with. And then once I have a decent understanding of, okay, this is what I'm observing, I try to find what is the path of least resistance in that. So if I'm objectively seeing a lot of intraday reversals, a wide range, a higher VIX environment, then my guard is going to be up. I'm going to be a little bit more defensive, and I'm going to be on watch for those intraday reversals a lot more. I'm going to assume that a lot more breakouts fail and stuff. I'm going to assume that a lot of down moves might, revert back a little bit without a catalyst. So just being a little bit more in tune with things like that. And then knowing that when you have a confluence of things, so when banks are weak and tech is weak and you have a macro negative catalyst, you're much more likely to have trend days, and then you can focus more on moves that continue as they find a new equilibrium. So I'm not sure if you want me to pull up some charts yet, but I'm happy to, or we can wait until a little bit later in the interview if you choose, Anthony.
Yeah, absolutely. I think, that already gives us a lot of information to discuss. And yeah, absolutely. I'd love to see the charts that you think are really, really important to illustrate these concepts. One thing that I noticed there was, the volatility and the intraday ranges. For some types of trading, it seems like, and correct me if I'm wrong, that is absolutely what they want to see. That's almost like a trader's market, some people will say. Whereas other types of trading styles or systems, that's absolutely the antithesis of what they're looking for in their system to provide gains. So, are there certain types of, either instruments or trading styles where this market is more suited for certain traders versus more harmful for them?
Yeah, I think it really just depends on time frames. So a lot of traders have a preferred time frame all the time. They either like just intraday or they're much more active in just swinging, something more multi days or multi weeks or multi months. And so what I like to do is I like to think about what time frame makes sense for me to trade. If I'm trading mostly, if I'm looking for same day catalysts or things that are setting up that same day, and we're in a market where there's a lot of reversals, I'll have a lot of my attention on intraday moves. But in the background, I also know that if we were to get a regime change, then obviously swing trading is going to be much more favorable in that environment. So what I'm doing is I track what are the best potential swings so that if we were to get into a more bullish market regime, what would be my go-tos? What tends to happen in choppy markets is that you get really strong names, they'll consolidate instead of breaking out. And so what that can actually mean is that you get better moves when you do get into a more bullish market regime because they've had so much time to consolidate. And consolidation is really just a level of equilibrium becoming more solid. And so the longer that happens, when the eventual breakout does take place, a lot of times it's even better off. And so even though I might not be trading things on a longer time frame, I still have a couple of things, but I'm more just aware of what I want to trade when we go into another market regime because when my timeline is more aligned with the market conditions, then it's much more likely to follow through. So I think that's something that can help people, is to not force your time frame on the market, but track your time frame, and then when the market aligns with that, really press and lean into that.
And Dawson, are you noticing the similar type of thing with time frame on some of the smaller names as well? Maybe something that you'd hold for an entire day or overnight. You're sort of compressing that timeline.
Yeah, for sure. They are insulated a little bit where they small caps will trade kind of with an anchor, like some sort of a sector leader. When we've had like miners recently or crypto or something like that, those ones will typically have the sustained momentum. But when we're just going day to day and we are in a choppier range bound market, just the day to day of breakouts and multi-day runners aren't as frequent. I'd say the frequency of trades isn't as prevalent. So we're getting a lot more moves where typically I would be swinging like a multi-day breakout, something that pushed 3 to 5 days ago, re-breaking those highs, and it's topping out later that day and not having the day two follow through. So the timeframes definitely are shrinking, and I think that comes when retail's banking and when stuff is working and continuing on highs, there's more money. But like I consider like the maximum dollar block, where that's the amount of money retail has to throw into the market. And when a bunch of traders are losing money, like what happened during the silver and gold run, is that was kind of that point where I noticed the shift, was when silver kept going. Everyone was looking for the short trade and it just kept going higher. So now there's not as much money flowing kind of down the chain into those smaller cap names. So it's definitely an environment to take profits quicker and be more selective, especially in small caps right now.
And Chris, I'd love to be able to go over some charts. Can you let us know what you're looking at in the markets and what you're noticing, what you're seeing from your perspective?
Yeah, absolutely. So starting with SPX or SPY, whatever people like to have up. So this is just kind of the example of how the index has been very range bound, as you've had a lot of things under the surface go in opposite directions. So that is one observation that I mentioned. The other one is a higher VIX environment. And the VIX is basically a measure of 30-day volatility. So as the market looks out over the next month, if there's multiple catalysts or if there's multiple things that could potentially move the market in a big way, you'll tend to have the VIX rise. And so in a higher VIX environment, the market is expecting larger moves. And so you can have larger swings in the market. And then a couple other things I just want to highlight. So beneath the surface, we've seen a lot of this, massive unwind in the software names, and that's like the AI disruption theme. So a lot of these software names that have historically traded at very high multiples, the reason why they've traded at that high of a multiple is because people expect the future to be significantly better for them. They expect earnings to grow, they expect revenue to grow, they expect their TAM, or their total addressable market, to grow. And what happened is that as AI becomes more advanced, that is disrupting a lot of that. And so those valuations come in to reflect those changes, that maybe someone can build an app very quickly that can replace a lot of the business models of some of these companies. So that's like a big theme that you've been seeing in this market of like real AI disruption losers. And a perfect name for something like that is INTU. And this is basically, tax disruption, as people can, do tax software things with AI now that used to have almost like a monopoly in, or a very small number of winners before. That's another great example of some of the names that are being disrupted. And then you have the AI winners, and a lot of these revolve around bottlenecks. So if you look at names like LITE or TER, VRT, FSOY, and then even the memory names like MU and SNDK, basically, as the AI revolution rolls out, where are there bottlenecks? There's bottlenecks in the memory sector, and what happens is that as there's bottlenecks, these companies can charge whatever they want, and they can get pre-commitments from companies, and so they can raise prices, they can lock in long-term gains, and so their fundamentals are moving in conjunction with that. So that's something else that I notice a lot in this market, is that you have fundamental drivers to a lot of these sustained moves. So even while the market itself is a little bit more choppy, if there's a strong enough fundamental driver that's improving the overall outlook of a company or a sector, that can drive it further than a lot of people think. And so, people have to be aware of that and then make sure that they're structuring their trades around, what could disrupt this trend in place, and then having proper signals like either trend lines or some kind of a technical aspect to help them to frame their trades. And then the last thing I'll kind of mention for right now is you had some strong names stuck in consolidation. And so like NVIDIA, as the Mag 7 names have increased their CapEx and everything, that all flows into NVIDIA. But as you can see, even though the fundamentals under NVIDIA are technically improving, you have consolidation where usually you would have a breakout. And you can see something very similar in a name like BE, which I've had a swing on for a long time. Even though everything's going right with it, good earnings, positive catalyst, you can see that there's a lot more consolidation. So it's more tracking these names and being prepared for when they break out, when the market regime shifts, instead of, being frustrated of why is this, stuffing on an upper end of a range, whereas that's just expected in this market. And then, over time, once you have a market regime shift, that's when it's much more likely to follow through. So those are a couple things that I just kind of keep in mind and that have helped me to just, observe what is actually happening and then aligning my time frame, my trade thesis, and my strategies with the market to try to find the path of least resistance.
One of the things that I hear people say is that right now breakouts are really struggling. And so people who are used to seeing breakouts in sectors, like software or, choose whatever sector you're used to continuing to build and being bullish, there's a lot of either chop or just downside there. And so, how would you recommend people approach trying to buy a dip or buy a breakout, to avoid sort of this catching a falling knife or averaging into a loser kind of thing? Like what approach would you recommend for people who might have a hard time in this current market to get back in?
Yeah. So my friend Pradeep Stockby, he has a great saying, and he trades a lot of breakouts and a lot of momentum longs. And the question that he asks himself every single morning is, are breakouts likely to work? And he's what he's doing is he's taking a temperature check of the market. And for someone who trades a lot of those kinds of breakouts, he's understood that not every market regime is conducive for that kind of strategy. And so he's always doing a temperature check every single day where instead of just forcing his bias on the market, he's saying, is my strategy likely to work in these market conditions? And if you notice repeated stuff moves, or if things are just having a hard time breaking out, then you adjust your strategy. You start to trade a little bit less. You might, sell a bit into strength where you might have let that ride a little bit more aggressively before. Maybe you look for another kind of strategy where instead of breakouts, maybe if something's struggling to break out to the upside with a lot of range, maybe breakdowns are working really well. And so, if you're just looking for a good continuation move to participate in, that's not necessarily always to the upside. Sometimes it's to the downside. And so just kind of flipping your bias around and inverting the problem, which Dawson and I have talked about a lot, that's something that can really help people.
Yeah, and Dawson, I wanted to get your take on that because I know you also trade to the downside and trade every now and then some of these larger names. So is that sort of something that you're looking at as well, potentially, going to the downside and finding some profit to the downside on some of these names?
Yeah, I dabble into large caps basically when they start to trade like small caps, when I can get the same daily chart patterns. My approach is always top down, daily chart, and then figuring out how to trade it on the intraday. And back in like 2022, 2023, when we had that pullback in the overall markets, we weren't having breakouts and continuation. That was one of those market cycles that I noticed. So the stuff I was trading back then wasn't working. So when we get into another environment where SPY isn't continuing to make new highs, we aren't getting those multi-day runners and sustain momentum. So I had to adapt and try to expand that playbook. And this was probably 6 months to a year ago when Chris and I had this conversation of, I was getting frustrated and what I was doing wasn't working. That's worked for so long. So then I start to adapt into those breakdown trades where we had stuff like AVGO recently that started to break down, and we had like I read through some AI reports that like 70 to 80% of the gains in recent months was based on the AI theme, whether it was strictly AI stocks or companies just getting into AI. But that was responsible for most of the move in the recent market trend a few months ago. And now we've got a ton of names outside of that AI theme that are pulling back and correcting, which is healthy long term. But a few of those other technology names and stuff that Chris had presented, they're still up at highs. So you get that kind of balance of names that are still holding up the overall markets, and then other names that are completely capitulating, stuff like Coin and Hood, and those names with a bunch of profit taking. That's where you get that kind of chop. So in this current chop, I'm not trading a ton of small caps, but when we had that crypto pullback, that kind of crash, so to speak, where it pulled back about 50%. Now we've got a sector theme. We've got some panic setting in into a sector that has some sort of predictability. And now I see some edge in reacting to that. And in this choppy market, I'm not looking to trade daily. I'm looking to pick a spot maybe once or twice a week and really size into that instead of trading regular risk 5 days in a row. Then maybe taking one day and just size into it like 5x compared to what I would be trading, just lowering that frequency and changing with the cyclicality of the market.
Given the sort of nature of this volatile market, what advice would you give to traders who are looking to either start to short or, thinking about maybe staying on the sidelines? Is there any advice that you would give to them, whether, here's an easy way to get involved on the short side, or here's some advice about what to do next? What advice would you give to those people? Because I'm sure they're asking you guys.
Yeah, I think the process of, learning new strategies, it's best done during slow periods in the market like this. So when people are, a little bit less active, like Dawson was saying, he's maybe trading a couple of times a week instead of trying to force a trade every single day. What do you really do with that downtime? And a really productive way to spend that time is to build out your playbook, to learn new strategies, to just observe who's doing well in this market and what are they doing. Where is the magnitude of the market? What is following through versus what is, being a little bit more range bound? And, just realizing that over a career in trading, you're going to encounter dozens and dozens of these market cycles and regimes. And if you spend, all of your time during these periods just forcing what you're already doing on the market, instead of just, appreciating that it's a slower period and then building out that playbook, learning those strategies so that the next time you see a market cycle like this, you're good to go. I think that that's a really a key trait of adaptable traders. It's making good use of your time and just trying to use slow periods to better yourself, better your trading, and to just round out, your strategy so that you have, things to do when these market cycles happen again, even if they seem a little bit frustrating, as you're experiencing them.
Yeah. And Dawson, anything to add there for people wondering about how to proceed in this market? Get in with certain, easy way to short, or sit on the sidelines?
Yeah, typically my process for expanding the playbook, even if it's just not limited to trying to get to the short side, but just in general, is I always start trading smaller to collect data, and I input all my trades into a spreadsheet. So I categorize everything by what market cap I'm trading, so I know what kind of if I'm trading small caps, large caps, and then I categorize it by setup. So then it gives me data on what I'm good at and what areas, whether I want to pursue those. If they're time-tested, proven strategies, then there's areas that I have to work on. But you could also just have a knack for identifying large cap breakdowns, and maybe you start trading those small, and then in your spreadsheet, it goes to show that, oh, wow, you're actually really good at trading this, and it just makes sense to you. It fits with your personality. So I always start with the data first when I'm looking to build that playbook. and then just identify what I'm good at, do more of that, and work on the other areas that you struggle with.
Yeah, I think that's great advice, right? Start with the data, see what's working, and if you can actually execute it and see some sort of profitability. Dawson, I wanted to ask, what are you seeing in small caps? I wanted to spend some time on small caps. There's always sort of a cyclical nature to small caps. They might be running or they're a little bit quiet. What are you seeing in early 2026 and during this current market?
Yeah, for sure. It's well, I'll start dating back kind of into the fall, because into that September, October kind of area of small caps, we had runners daily. It was almost too much to watch. And then kind of going into the end of November into December is when it started to slow down. And now coming into this year, that little drawdown period that a lot of traders had started to feel December into January, I think was partially due to the small cap sector slowing down. We weren't having as many runners where we'd get 300 or 400% gappers every morning. They weren't happening. Stuff wasn't running for multiple days. And that sort of became a theme where these 30 to 50% runners were more common instead of the 100 to 300% runners. So there's just when you're trying to capture a meat of the move, and that the amount of the total meat that you're trying to capture has been reduced, it makes it a lot harder to capture that smaller portion of the entire thing. So when ranges start to tighten, it does make it a bit difficult, and that's where I start to try to pick spots and reduce my frequency of trades when that sort of small cap cycle starts to come around. So we had a bunch of cheap names, some previous. I guess you could call them like liquidation names, whether they were related to the China or the pumps like a few years ago. We had a bunch of those like 30 cent, 50-cent names running to a couple bucks. And then like back in January was a main focus on the precious metals and like silver and gold space. Coming into this month, one of the main trades I was focusing on was the crypto sector, in relation to like coin and hood and those kind of sympathies. Going back in January, we had like NOM in the small cap space related to a bunch of the silver names as well. So I think it's just finding that area in the market and taking advantage of it. And when times are hot, make sure you're swinging the bat hard, because that period doesn't last forever. Basically, when the market is hot, you want to be swinging the bat hard, and when stuff starts to slow down in small caps, you need to be more selective in picking your spots. Back in September, October, it was quote unquote easy. There was money to be made in a lot of different areas. A lot of different traders and their strategies were making money. But when you go to like the recent silver and gold run, which was prominent here into 2026 when we got that speed up trade, and it started bringing in some sympathies like NAAM or NAMM now. And this was related to the gold and silver sector, a mineral name, and kind of got picked up with some momentum. And that's typically an area that I like to focus on, is when you get those hot sector themes and an anchor kind of dragging them with it. That's when you get these multi-day runs. I consider them sustained momentum, and you get like multiple legs that continue to build. So this was like a main trade where you get like a multi-day run, a mean reversion trade, a multi-day breakout, an overextension, like a clear out first red day. And you get like all of these segments of daily charts starting to play out. And that was one of those moments in past market conditions where I was good at trading the mean reversion, but how do I catch the long side? So then using that time when those overextensions were working out, and using that slower time to start to expand that playbook. We've had some other recent runners like QNCX coming from cheap and recent like liquidation type trades starting to bounce off the bottom. We had JZXN recently, was another one that kind of collapsed, a cheapy name coming from a buck starting to run. We had CCHH was another one, recent liquidation coming from cheap, going off the bottom. So kind of identifying these, they're not quite sectors, but retail traders have short-term memory and they always try to find the next one. So when you can identify that runner and try to find some personality or some characteristics of it that could help you identify the next one, is what's been working currently in February in terms of small caps.
It's really cool to see small caps just still having these opportunities while the larger market is a little bit, getting its footing right during this market and regime change, as you were terming it, Chris, which I think is appropriate. One way that I wanted to think about the next part of this video is ending it with a couple, maybe two or three main takeaways, or suggestions that you would give to traders, for to survive and to thrive in this type of market. It doesn't have to necessarily be 2026, because years from now there will probably be another type of market like this. So Chris, maybe we could start with you. What are two or three tips to survive and thrive in this type of market?
Yeah, I think that that's a great point that, this current market is just an example of a broader process of when the market is, not so favorable towards your, strategies necessarily. I think that using these 3 points can really help anyone to do better in periods of uncertainty, do periods in choppy markets, and just to really help to round out your career. So the first thing that I would recommend as people encounter a market like this or encounter a more difficult market is to maintain a position of strength. And so I say that all the time in Investors Underground. And what I mean by that is that you want to do your best to limit losses. You want to be a little bit more defensive. And your main goal should be not getting yourself into a big hole that you have to dig yourself out of. One of the greatest assets that traders have that's not talked about very often is their ability to make good decisions. And people are able to make good decisions and to make rational decisions when they're in a position of strength, when they're not desperate, when they're not scrambling, when they're not panicked, or just feel crippled by uncertainty or fear. And so what you really want to do is just to both protect your mental capital and your physical capital. And what can happen is that even if you have a difficult market, if you have kind of your guard up, if you're a little bit more defensive and you maintain that position of strength, even if you didn't do much during that market cycle, when it changes, you will be in a stronger position than probably 90 or 95% of other traders who have so many paper cuts and losses and mental things to untangle that a lot of times they miss the next market regime because they got so beat up in the current one. So really focus on maintaining that position of strength above all things, and don't focus on any particular position more so than maintaining that position of strength. It's not worth it. Your greatest asset is your ability to make good decisions, and you do that from a position of strength. So what that naturally means, and this leads into this next point, is that you will be most likely trading a little bit less. So what do you do with that downtime? You learn, you observe, you build out your playbook, and you do things that are productive to your overall trading business that might not necessarily be pressing the buttons. A lot of traders think that I am a trader, I have to trade all the time, and if there's not a trade in front of me, I feel lost. Or people sometimes, especially in traders, they're looking for some of those dopamine hits of the action. But really, it's about understanding that there's going to be slower periods, and to use that to think long term and say, if I were to use this downtime wisely, would that benefit me in the next cycle? Would that benefit me over the course of my career much more so than trying to force a trade and just get chopped up in a regime? So that's the next point, is to use downtime wisely and to really develop as a trader when you have the time to do it. And then the third thing is really developing the soft skills of trading. And what I mean by that is things like patience. If people are struggling not to trade when the market's a little bit slower, why is that? And it's because a lot of times the market can just drown out, all these areas that people really need to work on within their own trading, but it doesn't get exposed until you have a more difficult market. And so if someone's really struggling with something like patience, or something like, do I have the ability to just not trade today? Or do I have the ability to just focus on something else? If they're struggling with that, focus on that and use those slower times to do that. So that would be the third thing, is really develop the soft skills of trading. And then also, you can use that time to evaluate what is your relationship with trading and with the market. Is it an addictive one, an impulsive one, or is it one of, I'm using this career to help to better my life, and these are the things that I need to do to kind of help that along. And then really just making sure that your compass, quote unquote, is set to true north. Am I using trading as it's intended to be, as it's going to help myself, my family, and others around me, versus I'm just someone who needs to compulsively be at the market. So that would be the third thing, just kind of developing those soft skills and making sure that you're using that downtime to align your life and your trading with where you want to be. Because sometimes when you're so caught up in a busy or a hot market, those conversations don't happen internally, and years can go by before people start to realize that I need to make some changes. I need to realign and get back on track.
Yeah, thank you. I think those are really, really, really important aspects to understand in this particular market cycle and this regime, and moving forward for all traders. This might be a perfect time to use as reflecting and looking inward to understand. Maybe people don't even understand until they get a catalyst to look inward and think about if they're impulsive, why they're trading the way that they are. So thank you. I think that's really, really great advice. And Dawson, for you, what advice would you give to traders, to survive and thrive in this type of market?
Yeah, for sure. One thing I like to keep in the forefront is that we're paid in opportunity and not in hours worked. So if you're comfortable in a certain situation, a certain scenario in the market, stick there. And when it's not as easy and free flowy to just throw money around and make money everywhere, focus on the opportunities that you're best at, that you're most comfortable at, and not be sitting there smashing buttons all day long, because you're churning and burning. You're not getting anywhere. You can spend time outside of the screens, whether you're watching video lessons, whether you're in the chat picking up guys' commentary, whether you're scanning or watching courses like Legends Playbook or something like that, where you can gain knowledge without having to have the screen time and be tempted to push things. So wait for opportunity and not just feel like you have to do something because I'm a trader. Another thing I would say is preparation breeds confidence. If anyone watched like the Alex Honnold climb, he did some interviews afterwards talking about he's not afraid of falling because he's comfortable in the amount of preparation and work he put in ahead of the climb. So there's no real emotion involved to doing it. He's just having a good time. And I think that success leaves clues, and that sort of mindset, I think, can come into the market where you get confident in 1, 2, 3 setups, and maybe you focus there because the preparation you do outside the market, the homework in the evenings, the scanning in the mornings, building that big picture plan. So I think it's more important than ever in slower times when things are difficult to really have more criteria to the trade and be needle focused on exactly what you want to see. And gain that confidence when things aren't working, to just trade less, have a more finite idea of what you want to see happen. And then the third thing I would say is in like something that's range bound, because when everything is working bigger picture, the top down approach works. When daily chart patterns are working, big picture breakouts and breakdowns, when we're going into this range bound time, it works better to shorten down your time frame and not be looking at multi-week, multi-month ideas. But when you get some sort of shove into resistance or a flush out into support, being able to react to that, not so much scalping out of it, but maybe like multi-minute, 30-minute, 1-hour trades, and just not maintaining that bias. So those would be my 3 main points. and kind of what's been helping me over the last couple months.
Yeah, those are collectively a really, really solid set for people to think about and to implement during this particular volatile uh, part of the market. And I just wanted to mention, for anybody listening who's having a hard time in the markets, Chris, Dawson, myself are all members of Investors Underground. There's a lot of great tools and mentors there. There's lots of watch lists every night. There's weekly sort of community webinars that people are in to discuss, what they're doing well, where they have trouble, and everybody's coming together to become a better trader in Investors Underground. So for anybody watching, feel free to reach out to Chris, Dawson, or myself if you're interested in checking out some of the tools and resources that are offered in Investors Underground. So with that said, guys, thank you so much for recording and sharing what you're seeing in this volatile market, and any closing remarks or things that you'd like to mention to anybody watching or listening.
Yeah, well, it's been a pleasure, Anthony, and I really like talking about this topic, and I, of course, enjoy talking with you and Dawson about it. And I think that like one of the big takeaways is that when people encounter difficult situations or difficult markets, to just try to focus on observing reality rather than forcing what you want to happen on the market. I think that's what gets people into a lot of trouble, is they just constantly are trying to make something work that the market is just not ready for it. It's like swimming against the tides of the ocean. You're just going to tread water or you're going to get swept in the wrong direction. So you just want to align yourself with what is the market already trying to do, find the path of least resistance. And if you don't have a strategy for that, then use this time to develop a strategy for that. And that's really what you can do with these slower periods, is just try to observe what's happening and then put in the time to actually, align yourself with the market. And I think that can make all the difference for traders encountering any kind of market cycle.
Mhm.
Yeah, and the topic of this kind of discussion, the survive and thrive, is perfect, because you just want to survive long enough through that period where you're not thriving, and just survive through it long enough until you can, because you can't win at trading. It's an infinite game. You just get to keep playing. So just survive through those hard times until your quote unquote your market comes back, that you can thrive in. Just don't bet all the chips and run out of and spend your stack before the opportunities come back into your wheelhouse.
Yeah, absolutely well said. And Chris, Dawson, it's always a pleasure. Thank you guys so much. I look forward to seeing you guys in Miami for Traders for a Cause next week. So thank you so much.
Thank you,
bet.
guys.
Cheers,
I
guys.
appreciate it.